Did you know that not properly reporting your crypto transactions can lead to massive fines and even IRS audits? With new rules rolling out in 2026, getting your crypto taxes right is more critical than ever. In this video, you'll learn exactly how to navigate the complex world of crypto taxes, from gathering your records to filling out the right forms. We'll break down the IRS's property classification, explain the difference between F.I.F.O and specific identification for cost basis, and walk you through completing Form 8949. Get ready to conquer your crypto taxes and ensure you're fully compliant.
Here's the deal. The IRS has treated cryptocurrency as property, not currency, since Notice 2014-21. This means every time you sell crypto for dollars, trade it for another token, or even spend it on goods, it's a taxable event. Think of it like selling stocks or real estate. The IRS has been steadily increasing its focus on crypto. Starting in tax year 2019, the Form 1040 added a direct question about digital assets. Answering that incorrectly, that's a false statement on a federal tax return. And by 2025, the Infrastructure Investment and Jobs Act is bringing in new broker reporting requirements for centralized exchanges via Form 1099-DA. This means the IRS will have more data than ever before, making compliance non-negotiable.
Before you can even think about calculations, you need every single crypto transaction record from the tax year. This means buys, sales, trades, and any income received in crypto. For buys, you need the date, amount, and price paid, including fees. For sales, the date, amount, and proceeds received after fees. Crypto-to-crypto swaps, those count as two transactions, a sale of one asset and a purchase of another. Don't forget income from mining, staking, rewards, airdrops, or payments. Even your DeFi activities like dTax swaps or liquidity pool deposits need to be tracked. Most centralized exchanges let you download CSV histories, but for DeFi, you might need to dig into blockchain explorers like Scan or SoScan. Remember, the burden is on you to prove your cost basis. If you can't, the IRS might just assume it was zero, making your entire proceeds taxable gain. That's a huge tax bill you want to avoid. Now let's talk about your cost basis. This is simply what you originally paid for your crypto, including any transaction fees. Your gain or loss is calculated by subtracting this cost basis from your proceeds. The IRS recognizes two main cost basis identification methods, F.I.F.O, or first in, first out, where your oldest coins are considered sold first. And then there's a specific identification, where you get to choose exactly which specific units or lots you're selling. This includes strategies like H.I.F.O, or highest in, first out, and L.I.F.O, last in, first out. If you don't specifically identify which units you're disposing of, the IRS will default to F.I.F.O to use specific identification. You need meticulous records showing which lot you sold and when you acquired it. The method you choose can drastically change your tax outcome, so understanding the difference is crucial. Let's walk through an example to really nail this down. Say you bought one Bitcoin on January 15, 2025 for $42,000. Then you bought another Bitcoin on June 3, 2025 for $68,000. On December 10, 2025, you decide to sell one Bitcoin for $95,000. Now, if you use F.I.F.O, the IRS assumes you sold the first Bitcoin you bought, the one from January. Your gain would be $95,000 minus $42,000, which equals $53,000. If you held that until after January 15, 2026, it would be a long-term gain. But if you used a specific identification method like H.I.F.O, you could choose to sell the Bitcoin you bought in June. In that case, your gain would be $95,000 minus $68,000, resulting in a $27,000 gain. This would be a short-term gain since you held it for less than a year. See how the choice of method can significantly impact your tax bill? It's not just about the numbers, it's about smart strategy.
Once you have all your transactions and cost basis calculated, it's time to tackle Form 8949. This is where you list every single crypto disposal. The form is divided into two parts. Part 1 is for short-term transactions, meaning assets you held for 1 year or less. Part 2 is for long-term transactions, for assets held more than 1 year. Each part also requires you to check a box indicating whether your basis was reported to the I.R.S. For example, Box A is for short-term transactions, where the basis was reported on a Form 1099-B or the new Form 1099-DA. For each transaction, you'll need the date acquired, date sold, proceeds, and cost basis. After you list all your transactions on Form 8949, you'll summarize your total capital gains and losses on Schedule D of your Form 1040. Don't forget, any crypto received as ordinary income, like from mining, staking, airdrops, or payment for services, needs to be reported on Schedule 1 or Schedule C. This is separate from capital gain.
This all sounds like a lot of work, right? Manually tracking hundreds or thousands of transactions, calculating cost basis for each, and filling out forms can be incredibly complex and error-prone. This is where tools like dTax come in. dTax can automatically import your transactions from 22 supported blockchains, including 16 EVM chains like Ethereum, Polygon, and Binance Smart Chain, plus Bitcoin, Litecoin, and Solana. It also connects to 29 CSV exchange parsers for your centralized exchange data. What's even better? dTax offers 13 different cost basis methods, including F.I.F.O and H.I.F.O, and its best method optimizer can compare them all to show you which one saves you the most money. It even has a pre-audit sandbox to scan for I.R.S. audit risks before you file. You can start for free with unlimited import and 5 AI chat questions a day. Check out getdtax.com. It's open source and free to start.
Alright, let's hit some frequently asked questions. First, are NFTs taxed the same way as other crypto? Yes, NFTs are generally treated as property by the I.R.S, just like other cryptocurrencies. So selling an NFT for profit is a taxable event, subject to capital gains. Second, what about crypto donations? If you donate crypto to a qualified charity, you generally don't have to pay capital gains tax on the appreciated value, and you might be able to deduct the fair market value of the crypto, but you need to follow specific rules for non-cash contributions. Finally, what if I lost money in crypto? You can use those capital losses to offset capital gains. If your losses exceed your gains, you can deduct up to $3,000 of those losses against your ordinary income each year and carry forward any remaining losses to future tax years. This is a powerful strategy called tax loss harvesting, similar to how it works with stock.
Navigating crypto taxes can be complex, but with the right information and tools, you can stay compliant and avoid unnecessary stress or penalties. Remember, the IRS is increasing its oversight, so proactive reporting is key. Don't wait until the last minute. If this video helped you understand your crypto tax obligations better, please give it a like and subscribe for more essential crypto tax insights. Thanks for watching, and I'll see you in the next one.